The world of investing is continually changing, and investors are realizing the potential of alternatives. These assets invest beyond traditional stocks and bonds and are projected to grow in deposits by 62% between 2020 and 2025. With these changes and level of growth come new opportunities, new risks, and more learning required by investors to keep up. My job is to help make the complex as simple as possible while not leaving out any pertinent details. So let's begin. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. While many assets can be labeled as alternative or non-traditional, we're going to stick with the three main types: private assets, hedge funds, and structured products. Private assets can be equity, debt, or real estate. These assets are frequently more complex and less frequently traded than their public counterparts, but they can give investors access to additional sources of income and growth. Low interest rates and high correlation in the public investing space have encouraged investors to look into the private space to meet their investment goals. Subsequently, this sector of the market has grown substantially in the past 20 years. Many private investments have become more friendly to the average qualified investor as well. They're often offering tax reporting friendly 1099s instead of K1s, the investment minimums are lowering, and the holding periods are shortening. When looking for growth and income opportunities in the private space, it's important to ask if the investment you're considering has the tax efficiencies you're looking for, the diversification that you expect, and the fees are reasonable and that the predicted net returns are expected to meet your needs. Lastly, make sure you're comfortable with the required minimums and holding periods. For a deeper understanding of the private market, circle back and watch my video on private versus public investing. Hedge funds operate in the public space, but use less traditional methods such as short selling, leverage, and arbitrage to boost returns. Despite their long history, hedge funds remain a controversial investment, often with a public relations problem that makes them unattractive to some investors. The actual term hedge fund is notoriously difficult to define. While they started out as a method to hedge against loss in the stock market, hedge funds now operate with the goal to make money in any type of market or special situation. Investors in hedge funds have the same tax reporting, investment minimums, and fee considerations as private asset investors. Hedge fund investors are also looking for non-correlated growth investment opportunities and, by means of diversification, a way to lower risk in the overall portfolio. Like other public and private investments, hedge funds can be more on the conservative side or speculative side. For some investors, being able to access acclaimed money managers and markets outside the traditional stocks, bonds, and real estate is attractive. Investing in hedge funds takes extra due diligence. If this is an area of the market for which you qualify and would like to know more about it, email me directly. Structured products are often a mix of other traditional financial instruments like stocks and bonds and can have characteristics of both. The return at maturity and/or the income from a structured product is linked to the performance of an underlying asset such as a market index. This market has also grown in recent years for the same reasons private assets and hedge funds have grown. Investors are looking for more reliable income and for ways to hedge risk. Structured products are highly customizable and there is no one structure. Because of the great variety, it's important to note that these investments will require a learning curve for each new investment. Just like many other investment options, structured products can be conservative or speculative. Here are some specific considerations when researching structured products. Credit risk. Consider the issuer of the product the same as you would for any bond purchase. Income features. Make sure to understand how and when income is paid and any restrictions placed on receiving that income. Underlying asset risk. Look at what stock or market index is being used to help achieve your goal of income or growth. Call and maturity features. What are the terms involved for receiving or not receiving principal back at maturity? And also, what may trigger a call feature? Maximum return features. Look to see if there is a maximum return allowed and if you're comfortable with that limitation in exchange for other considerations such as income and/or principal return. Liquidity. Will you be able to sell this investment prior to maturity, and what are the ramifications, if any? Taxes. Check to see how your income will be taxed and if you should expect phantom income on certain products. These are not the only considerations, but understanding that you'll need to check in on more details with structured products will get you a long way. For some investors, the extra time and learning is worth it in exchange for potentially better income and enhanced features not found in other investments. I've been using various alternative and non-traditional investments for years now to help my clients achieve their investing goals. If you think you qualify as an accredited investor and want to know more about how these investments may help you, email me directly. Thank you for taking the time to learn more about these markets and look for new videos on your path to becoming a Rhino investor. See you there.